this event here at New America Foundation. I'm Paul Glastris. I'm a new fellow here at the foundation, also the editor of the Washington Monthly magazine. I hope you have the story in the Washington Monthly magazine with you that we're going to be talking about today, a big idea on the essential role of small banks, community banks, thrifts, and credit unions in our financial system. With us today is a very distinguished panel of New America Fellows and others to talk about this very interesting issue. We have, in order of appearance today, Phil Longman, who is Schwartz Senior Fellow at the New America Foundation and a research director of the Next Social Contract Initiative here, an expert on demographics, economics, and social change. Phil's written for such publications as the Atlantic Monthly, Foreign Affairs, Foreign Policy in the New Republic. He's the author of numerous books, including The Empty Cradle, Best Care Anywhere, Born to Pay, and The Return of Thrift. And he's currently working with Ray Bashara here on a book to be entitled The Next Progressive Era, formerly a senior editor and deputy assistant managing editor at U.S. News and World Report. He's won numerous journalism awards, and including the UCLA's Gerald Loeb Award. Next up will be Ellen Seidman. She is the Financial Services Policy Director in the Asset Building Program here at New America. She's also Executive Vice President at Chicago's Shore Bank Corporation, the nation's first and leading community development and environmental banking corporation. From 1997 to 2001, she was the director of the U.S. Office of Thrift Supervision, where she oversaw 1,000 savings associations across the U.S. She was also director of the Federal Deposit Insurance Corporation and chair of the board of the Neighborhood Reinvestment Corporation. And from 93 to 97, Ms. Seidman was a special assistant to President Clinton for economic policy. Next up, we have Joshua Rosner. Mr. Rosner is a managing director at the independent research and consultancy Graham, Fisher and Company, where he advises regulators and institutional investors on housing and mortgage finance issues. Previously, he was managing director of financial services of the financial services for Medley Global Advisors, the premier provider of policy information on monetary, fiscal, regulatory, and political developments to many of the world's leading banks, mutual funds, hedge funds, and other institutional investors. Mr. Rosner was among the first analysts to identify the operational and accounting problems in government-sponsored enterprises, the peak of the housing market, the likelihood of contagion in the credit markets, and the weakness in credit rating agencies. He is the author of many widely read and prophetic papers on these issues. Next up will be Jan Miller, President and CEO of one of the types of institutions we'll be celebrating today, Wainwright Bank. Prior to joining Wainwright, he spent 19 years with the Shawmut National Corporation in a number of positions, including President and Director of Shawmut's First County Bank in Brockton. He started his banking career in 1971 at Bradford National Bank in Bradford, Vermont. Mr. Miller is a former chairman of the board of the Massachusetts Bankers Association and a member of the Government Relations Committee of the American Bankers Association. And finally, today we'll have Doug McCrae, a California-based fellow here at the New America Foundation, author of a very fine piece in a recent issue of the New York Times Magazine. Doug writes about social and international issues, technology, and culture for Public Radio International's This American Life, also for the New York Times Magazine, the Atlantic Monthly, the Los Angeles Times, Foreign Policy, Wired, and numerous other publications. He's previously a features editor at Foreign Policy and has appeared as a commentator on CNN, NPR, and PBS's The Charlie Rose Show. So thanks for coming, and we'll begin today with Phil Longman.
Thank you, Paul. Good afternoon. Everybody feeling okay? You might have noticed there's a kind of bug going around town these days. The first symptom seems to be you wake up in the morning and your jaw is kind of sore. And then a few days later, you get this faint whiff of smoke coming out of your ears. And then as this bug runs its full course, the agitation builds until finally the sufferer just can't take it anymore and renounces his worldview. I call this cognitive dissonance syndrome, CDS. And you might have noticed that Alan Greenspan came down with a really bad case the other day in Congress when he all but repudiated Ayn Rand. Martin Feldstein was stricken. You might have noticed the former head of Reagan's Council of Economic Advisors wasn't such extremist that he penned a op-ed calling for a New Deal scale public works program to end the Depression. Now, I can't say that I have full-blown CDS myself, but if you detect a faint whiff of smoke, you'll know what's going on. For most of my career, I've been a financial journalist, starting in the 1970s, just when the Americans were learning about money markets and mutual funds. I covered the S&L crisis when that happened and the financial boom of the 1990s, including the repeal of Glass-Steagall. And all through those years, that long era, all the smart people said, and you were taken as antediluvian if you tried to object, that when it came to finance, big was better. You know, the dominant theory was that big financial institutions were inherently efficient through their economies of scale, but more importantly, because of their ability to match lenders and borrowers wherever they might be. So they could scoop excess savings out of China or Dubai and put them to work wherever in the world they would be most productively used. And under this dominant theory, which was very much informing the move towards deregulation, we had this anonymous global scale transactional banking that gradually, and not so gradually, replaced small scale relationship banking. Big banks taking advantage of deregulation bought up lots of little community banks spread across state lines themselves throughout ATM networks. Eventually, you couldn't even really tell what a bank was. You turn on the television and there's a lending tree telling you that when banks compete, you win. The message essentially was that if you were still doing relationship banking, you were a chump. And if you were doing transactional banking with anonymous global capitalists, you were smart. But now something's gone terribly, terribly wrong. Global finance scooped up the world's savings and did what with it? Did it invest in manufacturing? Did it invest in building our infrastructure back up? It did none of that. It invested it in subprime mortgages in places like Stockton, California, and East Cleveland. And it did so with incredible efficiency and creativity until it blew up. As the smoke clears, what do we see? We see two things. The first is we see hundreds of billions of dollars in bailout money going to the very Goliaths that created this explosion. And what are they doing with the money? Are they lending it out to small businesses or to anybody? No. They're using the money, by and large, to buy smaller banks and get bigger. And who are these small guys that they're buying out? Turns out, in the face of this worldwide contagion, there's another anomaly. And that is that the small-scale banks and financial institutions, community banks, thrifts, credit unions, are doing extraordinarily well. Ellen and I worked out that thus far this year, the bank failure rate for banks over $1 billion in assets is 7 times that of banks with less than $1 billion in assets. And on any metric you care to look at, return on equity, return on assets, number of defaulting loans, it's the little guys that are doing best. In fact, most of these little guys have metrics that look better than J.P. Morgan. So why is that, and what lesson can we take from it? Part of it is, admittedly, too dumb to fail, or too antiquated to fail. These guys didn't have access to the global capital markets. They were humble thrifts that stuck to their knitting. When the housing market froze up, they weren't leveraged many times because they couldn't be. But there's also a deeper lesson here, I think, as we go forward in trying to think how are we going to recraft the world's global architecture. And those lessons are essentially this, I think. One is that the humble depository institution, think of George Bailey and A Wonderful Life and his little thrift. We all remember the famous scene, right, where the depositors come and make the run. What's going on in that scene? A couple of things. One is there's a mutuality of interest in a community banking setting like that. George Bailey didn't lend out exploding subprime mortgages to his customers for the precise reason that he needed those customers to do well, to thrive, because he needed their deposits. And incidentally, he probably also met them in church. So it wasn't like Lending Tree that doesn't care what happens to you after you take the loan. George Bailey had to care about what happened to you. There's also something that our Fed chairman has called informational capital. And that is, if you remember the scene with Bailey talking to all these panicked depositors, and he says something like, "Your money's not here, Mrs. Kennedy. It's in Mr. Jones's house. And Mr. Jones, your money is in Mr. whoever's house." And they're all calmed down because they all know each other. They know each other's prospects. They can gauge each other's prospects. Another thing that community banks create and that is sorely missing now is social capital. I spent a good part of the 90s in Florida during the era in which big bank holding companies could for the first time branch across state lines. And it eviscerated community banks across Florida. And what that meant, among other things, was that all the philanthropical organizations, the United Way, the Ballet, whatever, now all of a sudden they didn't know their bankers. Their bankers were in Charlotte. Their bankers were in New York. And that had a real effect. It turns out that community bankers, about 93% of them are active in the local chambers of commerce. They have a mutuality of interest within their own community. If there's something going wrong with that community, they need to make it better. And so, although it might seem incredibly romantic and antiquated to talk about these little institutions, this very cognitive dissonance syndrome, I think, forces us to rethink this and rethink the importance of relationship banking and to de-emphasize transactional banking. And with that, I'd like to hand it over to my co-author, Ellen, who has done some work in thinking about the mechanics of how we might actually do that. Thank you.
Thank you, Phil. So what are the policy levers that we have available to provide additional support to this sector? I think first, before we get into any issues of finance or anything else, we really do need to focus on the regulatory lever that says, you know, these banks have been competing with institutions that didn't have to follow the same rules. Institutions that, if they wanted to make a crummy, exploding loan, nobody was going to be paying any attention. And it isn't just that someone was paying attention to the smaller banks. It's that the smaller banks cared and had no interest in competing in that way. But unless we can get the low roaders off the road, it's much harder for them to compete. So that's the first issue. And we can do this in any number of ways. We can do it through the kinds of regulations that the Fed put out earlier this year. We can do it through default products, which we spent a good deal of time talking about last month, and the paper that we published last month on the subject is outside. We can do it through what Elizabeth Warren has suggested, a Financial Services Product Safety Commission. There are many ways of doing it, but it really is a critical element. But on the financial side, these institutions basically need two major things. They need patient capital and they need deposits. Local deposits are critically important for connecting the institutions to their communities and connecting the borrowers to the institution, making sure that the borrowers and the depositors have a mutual interest in each other and that the institution has an interest in both of them, what Phil talked about. On the other hand, for institutions that are serving particularly lower income communities or depopulating communities, communities where deposits are hard to come by, we need to go further. They can't survive just on local deposits. Moreover, deposits are in general, at least nominally, short-term instruments. One of the things that's come out of this recent crisis is that Americans have once again learned that they really want longer-term mortgage instruments in particular, and the interest rate mismatch that occurs if you try to fund long-term mortgage instruments with short-term deposits is to some extent what brought us the savings and loan crisis. Not entirely, but it was definitely a piece of it. Beyond deposits, capital is also critical, and the proposal that we make relies heavily on that. Before I get to the proposal, I just want to sort of go through the other ways that these institutions can fund themselves and why we have to pay attention to those too. So for non-local deposits, back in the early 80s, we went through the era of brokered deposits, which had many problems. The Internet has to some extent responded to that by enabling there to be a direct relationship between the bank and the potential depositor instead of having a broker in the middle. Banks such as Shore Bank, which I'm affiliated with, and Wainwright have direct relationships with out-of-town depositors on their websites and attract them through not only a competitive rate but also their mission. So that has definitely improved the situation. We need to deal with the deposit insurance question. The deposit insurance rate insurance level has been raised to $250,000 per person per institution. It's only temporary, however, and if it drops back, that will be an issue for this issue of raising non-local deposits by these institutions. Secondly, borrowing against assets. This is essentially using the home loan bank system. It's been a really important part of how these institutions are funded. The home loan bank system so far has held up pretty well, although there now is some indication that there may be some pressures. On the other hand, what you do when you borrow against your assets through the home loan bank system is you make the FDIC rather unhappy because those secured assets are no longer available to the FDIC in the event of a bank failure. So it's a balancing act, and it's something that we, again, as we're working through this entire financial crisis, we have to be paying attention to how that kind of access to funding affects the smaller institutions. The third thing is selling loans. Again, particularly for the long-term mortgage loans, it's important to have a reliable, consistent outlet. Most community banks want to hold on to the servicing of those loans, hold on to the relationship with their borrowers. That's really important, but to be able to sell off the interest rate risk is quite important also. How we get through the Fannie Mae, Freddie Mac conservatorship and what comes out the other end is absolutely critical to the ability of community banks and credit unions to continue to write high-quality mortgages that are of the sort that American consumers really want. There's also fee income. I really don't want to go into that very much, but then let's go to equity. What these institutions need is to be able to have a solid equity base that they don't have to chase and that they don't have to promise fast, high returns to. This is extremely difficult capital to get. And it's extremely difficult capital to replace when, as is clearly happening now, institutions are having to recognize, even the best of the small institutions, are having to recognize a higher level of losses than they had to previously. Capital serves as a risk cushion. It also serves, of course, as the base upon which to leverage the deposits. So what we are proposing is a community banking trust fund, which would provide capital and technical assistance grants to community banks and credit unions. We've modeled it on the Community Development Financial Institutions Fund, and this could be inside the CDFI fund, or it could be parallel to it, or there could be some sort of new entity that covers both. The CDFI fund has been a staunch supporter in terms of both equity grants and technical assistance grants to about 60 banks, 140 credit unions, and about 600 loan funds and venture capital funds in the 10 years that it has been in existence. These are institutions that serve, that 60% of their activities must be in low-income neighborhoods. But this fund has never been funded at more than $120 million. It is not really designed for the banking industry, and it has had to fight for its life all the way through this last 8 years. So the point that Phil has highlighted is that while community banking is critically important in the low-income communities, it's important in our communities in general. And so this new proposal extends the definition and doesn't focus solely on low-income communities, although it is absolutely critical that we keep some focus and a substantial focus on those communities too. This proposal is focused on entities that can meet a standard which would have to be defined to be called a community bank or community credit union. As you know, there is a designation of community credit union. There's an argument about whether it's too broad. In the course of implementing any proposal like this, that would have to be revisited. But we're talking about a combination of things. We're talking about high loan-to-deposit ratios. We're talking about lending in the community for mortgages, for multifamily housing, for small businesses, for nonprofits, for the needs of the local government. We're talking about branches in the community. We're talking about board members of the community. We're talking about service to the community by the officers and employees of the institution. If the Community Reinvestment Act were operating the way it really should, we would be talking about institutions with outstanding Community Reinvestment Act ratings. I think that what we will be needing to do as we go forward on thinking about this is really getting this definition of community bank or credit union right. They do exist. They are out there. They are not defined solely by asset size, but we really do need to understand what they are. The Community Banking Trust Fund would provide equity in the form of, for example, and the Treasury has led us in this direction to some extent, preferred stock with a reasonable coupon that would be patient, that would not put pressure on these institutions to sell out, and that nevertheless would count as Tier 1 capital, as the highest level of capital. It would also provide grants to mainly the smaller institutions to enable them to deal with some of the higher fixed costs of being so small, particularly in things like information technology and meeting regulatory requirements. We took a stab in the paper at how much this would cost and what the funding would be. And frankly, when we started thinking about this back in the summer, the numbers that you see in the paper would have been completely unbelievable. They're not completely unbelievable anymore. They are what this government is doing, and doing in a pretty non-targeted, non-focused way that has nothing to do with the communities in which the community banks, thrifts, and credit unions operate. We took as a sort of standard a 13% capital ratio, which is conservative but reasonable in the banking industry and said, okay, let's take the class of all credit unions and banks and thrifts of less than $5 billion. And let's try to figure out what it would take to top those off to a 13% capital ratio. And let's use a sort of generous assumption of how many would, A, be eligible to be designated as community banks, B, want and need the money, and C, be in good enough shape so the government would not feel like it was sending its money down a rat hole. And we came out with the estimate of $30 billion. And you'll see in the paper how we got there. Now that sounds like an incredibly large amount of money, but this is 15,000 institutions we're talking about. The government made equity investments of $25 billion each in Citi, Wells, and Chase. So just think about the equity issues there. Ongoing, to sort of keep this process going and not get into the same situation as we've had with the CDFI fund, we estimate it would cost a maximum of about $7 billion. That's a lot of money too. But you know what? If you take a look at the 2001 issuances of asset-backed securities, the very kinds of instruments that help facilitate the mess we're in right now, a tax of less than 0.5% on those issuances would fund this very nicely. And this kind of tax on securities issuances is, of course, exactly the way the SEC is funded. This is not an unusual concept. Small-scale banking is incredibly important to this country for the reasons that Phil talked about. It creates a critically important mutuality of interest between borrower and lender, which makes for safer lending, and it also makes for much more community-oriented lending, and it makes for borrowers who understand they have an obligation to repay. It is a repository for savings, for helping people in this new economy of trying to deleverage, trying to come back out of a debt-based economy. It's a safe place for people to put and grow their savings. And as Phil pointed out, it's incredibly important for the kind of civic engagement that is really necessary as all of our communities rebuild themselves. In It's a Wonderful Life, George Bailey got to see how much poorer his world would be if he hadn't been there. Well, today, a world that passed him by looks ugly indeed, and our community banks, thrifts, and credit unions are a way of turning back the clock. Thank you.
Just stay in.
I actually thought I would just take a little bit of a chance to bring us a little background on really how we got to the mess that we are currently finding ourselves in, and really reconsider some of the uniqueness of it that really came from actually the consolidation that we've heard both of the speakers talk about. In 2001, I authored a paper called "A Home Without Equity is Just a Rental with Debt," which was in response to questions about from clients who asked, having just come out of a short-lived recession, are we going to see housing markets turn down as they typically do 12 to 18 months after a recession? And essentially, the analysis that I put forward was actually housing is going to outperform GDP for the next several years until such time as unemployment rises, incomes fall, or interest rates rise materially. Unfortunately, when any of those things happen, we're going to have hell to pay, and it's going to be disastrous, and disastrous of unprecedented proportion. The real driver for that, I would point out, was exactly that thing which imperiled community banking. We saw the industry move towards automated underwriting. Underwriting had always been done by local regional institutions, your local community bank. The banker knew you, he knew your family, he knew your circumstance. The loan was traditionally sealed with a handshake, and that was one of the sort of parts of underwriting that people don't really talk about, which is the firmness of the handshake, the look in the eye, that also disappeared. We moved to automated valuation models, which took the appraiser out of its independent blind pool historic role and first moved it to the role where the appraiser was really actually not serving the community, but was actually working on behalf of the realtor to make sure that the price worked, and later to automated valuation models. As we began to rely on the models, what we really did was make it impossible for the small institutions to compete, because to be able to turn around a loan in 30 seconds on a model that had never been tested was actually a compelling notion and allowed for the consolidation of an industry and the growth of the private label securitization market, which ultimately is what led to the private label RMBS, and in turn CDO, and in turn CDO squared and cubed, and in turn the crisis that we have today. I think that actually the community banking piece is a vitally important piece. In 2006, when I was warning of the dangers that large regulated institutions posed by their use of complex internally leveraged securities and derivative exposures as a major driver of their returns, there were not a lot of people who were willing to appreciate the model risk or the capital that should have been required to be held against those securities. It was that regulatory capital arbitrage which imperils today the existence of our largest institutions. And without those leveraged products, they'd actually resemble the majority of our smaller banks. The smaller institutions remain fairly true to their leverage ratio and the intent of the regulators. While a lot of the small depositories do have real problems at this point, those seem to be more of the degenerative disease nature. Typical, cyclical increases in losses on commercial lending, on construction loans, on home equity loans, etc., rather than the massive coronary disease problems that we're seeing at our largest institutions. I think we really need to actually reconsider in the midst of this crisis and step back and take a brief time out from a notion that actually today seems to be accepted broadly, that there are institutions that are too big to fail. That notion was actually one that we've only heard since this summer, when Secretary Paulson said perhaps we'd better recognize that maybe there are institutions that are too big to fail. But actually the notion violates everything that we've heard out of our regulators for most of modern history. I mean, we'd heard the Fed repeatedly for the past 15 years say, what we learned from long-term capital was that there is no institution that with proper amounts of liquidity and time cannot be wound down. And yet today we actually all think that there are no institutions that are too big to fail. So Treasury puts $25 billion in Citi, and we're all okay that Citi is not only not lending that back into the communities they serve, but actually yesterday goes out and spends $17 billion to repurchase assets from structured investment vehicles with our money. Okay? And we accept that because of this new notion that these large institutions are too big to fail. Perhaps we should stop and say, is there a rational or reasonable way to actually break up those large, systemically unsettling institutions and feed the carcass back for the nourishment of the small regional institution who does serve their local market, who do lend into their local markets, and who frankly would actually be able to play a very significant part in diminishing these systemic risk issues. Now that sounds like an idealistic notion and maybe perhaps a naive notion, but I think actually it's a notion that's probably more supportable than and more achievable than most are recognizing. We've seen the FDIC over the past several months announce that they're increasing their insurance guarantees to $250,000 for deposits, that they're going to guarantee non-interest-bearing accounts, and that they're going to guarantee the debt of institutions that qualify. That should reduce the risk of deposit runs. On the other side, You've got them promulgating a rule that really has gotten very little attention that actually will allow them to collect data on a troubled institution's qualified financial contracts so that they'll know every single counterparty exposure that a large institution has, okay, and who the counterparty players are. And so at some point in the not too distant future, it is not too hard to believe that if necessary, they could go into a large institution just as they would at a small institution and create a good bank, bad bank resolution where the risk of deposit runs has been diminished, where the counterparty exposures that are well collateralized pass straight through to the good bank, and those that are under collateralized go with the bad bank, and those counterparties become nothing more than creditors in the resolution of the failed institution. And that actually may become another mechanism to help fund the regional banks and strengthen them. And I think that we're in a time of unprecedented change thrust upon us, not of design, but that really calls for us to step back and really think about how we came to be here, what parts of our models have historically worked. I think we're going to start realizing that this whole period will be sort of determined or called when models failed. And perhaps we should think about that one of the few models that really hasn't failed is actually the local lending institution. And perhaps we should make sure that instead of allowing leverage to be and too big to fail to be something to aspire to, maybe unleveraged returns and soundness and ability to serve should actually again be one of the things we expect from our depository institutions. They serve a social utility, and so it's wonderful that management are able to actually generate outsized returns for themselves and for shareholders, but they also need to be able to actually serve their communities. And I think that's gotten lost, and perhaps in support of the community banks, we can find our way back toward that.
Let me take a couple minutes and introduce you to a community bank that Ellen and Phil have been talking about, one that is a little unique in its brand, but not too dissimilar to many others that are out there that do in fact need the patient capital that we're talking about today. Wainwright Bank was founded about 21 years ago. We're a publicly traded, state-chartered commercial bank in Boston. We've got about $1 billion worth of assets, 12 branches, and a thriving lending and private banking area and retail area, as well as an investment subsidiary, Heritage Capital. Like all banks, we offer basically the same products, same services, same pricing, same market as most of our other competitors. But as we've been told several times by bank analysts, consultants, and other industry folks, that we're really unlike any other bank in the country, even those that profess to be socially responsible. We're considered one of the leading socially progressive banks in the country. Let me tell you how we got to that point. And we've proven by allocating capital to the underserved markets is not only socially responsible but profitable. We've always contemplated two bottom lines. The social justice platform, our second bottom line, is in fact supported and fueled by our business platform, our first bottom line. They're mutually supportive, and the success of one is intertwined with the other. Internally, we have management practices that are lauded nationally as among the most progressive. We have low employee turnover, a generous benefit package that includes a public transportation subsidy, and we encourage diversity throughout the bank, our board included. We have 9 outside board members, 2 of whom are women, and 2 are African American. And our employees speak 23 languages out of 165 employees. I, on the other hand, struggle with just one. Externally, we've been recognized in the Boston area as the employer with the highest level of community involvement per employee. Our other activities, as I've said, include our lending practices, but how we invest our money and the products that we offer are seemingly unique to Wainwright, which is our social advocacy. Community development lending is a significant part of our business strategy. More than 50% of our commercial loan portfolio is devoted to nonprofit lending, homeless shelters, food banks, affordable special needs housing, HIV/AIDS services and housing, and other nonprofits. And there's a general assumption among bankers, if I'm out at investor conferences talking about the banks, and some folks in the room's eyes glass over when we start talking about this, because there's a perception that these loans aren't profitable. It's an extension of charity. But nothing could be further from the truth. Our community development loans are market priced. They bring significant deposits, and we've made over $700 million worth of these loans, and to date, we haven't lost a dime of principal. The majority of our customers are aware that our deposits fund these loans, and we attract new customers because they like the idea that their money supports local community development projects that they can see and read about, and they become fiercely loyal to the bank. We not only get media coverage because of this, but we also have received numerous awards, including the Treasury Department's Bank Enterprise Award. We've been lucky enough to receive that award, almost $2 million in funding from that. And we've used that to put back to work in the community. And we recently received a $25 million allocation in New Markets tax credits. And we believe we're the only bank in New England to receive an allocation at this round. And it allows us to provide further financing in distressed communities. In addition to community development lending, we've created some unique products within the industry. In 2001, we used a portion of our Bank Enterprise Award money to launch an online service for nonprofits called communityroom.net. In our branches, we've created a community room, physical community room, that nonprofits can use after hours for meetings at no cost. So there's after hours access. But this is a web-based community room that, among other things, offers a free hosted website and also the ability to accept online donations, which is critical for a lot of our smaller nonprofits that don't have the ability to build their own website that allows that capacity. And about 200 of our clients have taken advantage of communityroom.net. And last year, the donations that came through that totaled more than $1.1 million. So it's significant to our nonprofits. And we're told that no other bank in the country offers any service like that. And we've launched our green loan. That provides discounted home equity for energy efficiency. We have a unique product called our Equal Exchange CD. We got together with a for-profit coffee company that provides fair trade coffee and buys it from local farmers, mostly in South and Central America. The CD that our customers invest in provide collateral for a line of credit that Equal Exchange to use to provide working capital for their coffee growers. Another area we've gotten significant attention on are environmental initiatives. Most everybody's going green these days, but back in 1993 we started recycling our paper. We started using vegetable-based inks in our financial statements and monthly statements, and we've purchased renewable energy offsets and some other things. And we've been recognized as one of the top green banking organizations in the country and one of the top 20 sustainable stocks in the world. Our most significant environmental activities, though, involve around our branch building. Our last 4 branches we've built to be LEED certified. It's the Leadership in Energy and Environmental Design. When I first started talking about that, when we built our first branch, I had to explain exactly what that is, but it's become much more commonplace now. Our first LEED branch was the first bank building in New England to get the silver certification. They've got bronze, silver, gold, and platinum certifications that they've designated. And the next one received the gold certification. It was the first bank building in the country to receive such certification. But our most unique aspects of our corporate social responsibility, considering that we're a publicly traded company, is our advocacy on the behalf of social issues. because of the progressive causes we champion and support in various ways and the recognition we receive, we've created a certain amount of what we call cultural capital. We use it in many ways. To support the Employment Non-Discrimination Act, to file a letter with the Massachusetts General Court in opposition to the anti-gay marriage constitutional amendment. We were the only publicly traded company in Massachusetts, much less bank, to do so. And the endorsement of living wage in Massachusetts, just to name a few. And we've been fortunate to receive significant media coverage for a small $1 billion community bank based in Boston. And some of the, New York Times, Wall Street Journal Today, CNBC, Fox News, and other local and national newspapers. I don't mean to offend anybody, but I did actually say Fox News. And last year we were featured in a book, HarperCollins, by Christina Arena called The High Purpose Company. She and a group of 10 McGill University graduate students looked at 75 publicly traded companies that would identify themselves as socially responsible. And they created a metric and a new methodology to run those companies through. And they included IKEA, Toyota, GE. And Wainwright came out ranked the #1 ultimate high-purpose company. And we've also been included in Patricia Abergeen's Megatrends 2010, and most recently, Margaret Benefield's Soul of a Leader. So the attention that we receive for a lot of these efforts sort of go beyond our size. But to speak to the subprime crisis, we've never made a subprime loan, not intentionally anyway. We never bought an investment that contained subprime loans in our investment portfolio. We are making loans the old-fashioned way. We keep 99% of our loans in our own portfolio. And if I make a credit decision on a loan, I live with that credit decision. And that's why the relationship banking is so important, and it's critical to the community banking. We're growing our deposits, we're growing our loans. We've taken advantage of market opportunities to grow our residential lending and community development. You aren't hearing very many folks talk about the fact that they've grown residential lending in this environment. But in the last year, we've grown over 30%, and American Banker ranked us 4th in the country in the last quarter for residential loan growth. And our community development lending has grown another 15% over the past year. So our value proposition distinguishes us from our competitors and engenders a much greater customer loyalty, one that if I were you, I wouldn't believe, except that I see it every day. But we think that with the global awareness of sustainability and social justice, that this provides a platform for us to grow for many years to come. And we look forward to the dialogue that the community fund would create. Long-term patient capital is very important for banks like Wainwright to continue to thrive and grow. So, thank you.
Okay.
So I wrote this article, and I want to tell you why I wrote it. It's a profile of this business deal where a credit union, a big credit union, Connecta, bought the largest chain of check cashers and payday lenders in Southern California. I was wondering why they'd do that, but especially I wanted to answer a question, which is, why did alternatives to banks get so big? Right now, if you count up all the payday lenders and check cashers in the U.S., there are more than all of the Starbucks in the U.S., plus all the McDonald's. And there's a story about it that we know, that there was bank deregulation, banks left, payday lenders and credit and check cashers moved in, but it's only partly true. There was some Brookings research recently that found that 90% of check cashers sit within a mile of a bank. So it's clearly more than just geography that's at work. Now, it's true. Most of the services these places offer are too expensive. They make it too easy to spend and not easy enough to save. But common sense says that if they're getting this much business, they must be doing something right. And what I found was it's just a dearth of good mainstream options, especially small lines of credit. So I went to Nick's. I spent some time there. I spent some time behind the counter of this check casher and payday lender. I spent some time in the lobby. I spent 2 days standing in the parking lot outside a couple of them and just talking to everybody who left, which I don't recommend for your sanity. It's not fun, but very interesting. One of the things that people said was that going there was, for a lot of them, cheaper than a bank because they weren't going to rack up overdraft charges or fees that they didn't really understand or anticipate. And the fact is, if your balance is often close to zero, it can be really easy to get nailed by fees. There is also the issue of blacklisting. If you bounce too many checks, you end up on check systems, and then for 5 to 7 years, you can't get a bank account. When the state of California is going to be rolling out an experiment to try and encourage people to come to banks and is going to be encouraging banks to sort of lower their fees and in some cases their standards to bring new people into banking, they found that in some zip codes in California, 30% of residents were blacklisted, which means that in addition to the fact that you have maybe your landlord doesn't take a check, maybe nobody takes a check, maybe it's really hard to find a cash machine, 30% of residents can't bank even if they want to. And I thought about that especially when I was reporting this piece. I walked out into my neighborhood, which is a little bit like Cleveland Park or Adams Morgan or something like that. And I was walking down the street, and the guy in front of me was pushing a stroller and talking to his kid in the stroller about how they were going to open a bank account. And so I was falling behind them, eavesdropping, and all the way the dad is saying, well, we're going to open this bank account, and we're going to put some money in it, and we're going to save for you. I mean, the kid was stroller age, and that clearly doesn't happen if you are in a neighborhood with a cash culture. I went with Tom Nix to visit a credit union in the nearby. And we went to go see this credit union because he'd met the CEO at a conference. And the guy came up to him and said, we really want to serve more of the underserved community. But we can't. We're trying. We can't. They all go to this check casher nearby. And it turned out it was Tom Nix's check casher. So we went there to go see what this place was like, and he actually hadn't been there before. We were just in the neighborhood and decided to drop in. And the first thing you get to the door, and there's this box, and I don't know if you've ever seen one of these, but it's a big glass box with a huge metal detector and a locked door on the front and a locked door on the back. And then inside there's a marble lobby with a fountain and a woman in a suit who sits alone at a desk, and that's all you see. So you go into the box and it locks behind you, and there's this big buzz, and then the woman stands there and sort of has a look at you and decides if you're going to try to rob them. And then if she decides you're okay, then she buzzes you through. And then once you get in there, it's impossible to know what products they have, what services. There's nothing. There are just a few little pamphlets. And so we asked, well, what are some of the accounts here? What can you do? And we got led into the back and sat down at this sort of very formal marble desk and mahogany desk, and we left, and the guy who runs the check cashing business said, that's just crazy. That's just crazy that they want to serve my customers, and this is how they're presenting themselves. And you go back into the check casher, and again, I'm not apologizing for them because there are all sorts of problems with them as a business. But it's almost like a fast food restaurant. You get a menu of all the products and the services. It's really clear what everything costs. It's really clear what they offer. And it's a really simple product line. There aren't 10 different varieties of everything. There's one of everything, and you know what it costs immediately. And there are a bunch of other subtle things, sort of cultural things that they do that are really interesting. They hire from the community, and word spreads, and tellers know their customers, and customers know tellers. And I saw that when I sat in the lobby for several days and watched customers come in and ask for tellers who were on break, and the tellers would come back from break and they'd talk. They reflect the community in a way that's really interesting. I spent an afternoon with this woman in Watts, sort of a neighborhood leader, this woman named Sweet Alice. And she said that she'd banked for years, but she said, there are never any black tellers at my bank in this neighborhood. And she said, it doesn't matter that much. I don't care that I'm not going to not bank. But she said it just made the place seem a little bit alien. They also had a retail environment. It sort of felt more like a retail place. People were dressed down. They weren't in suits. And the fees were really transparent. And the customers, when I talked to them in the parking lot, that was a big deal. People would tell me explicitly they didn't mind paying a little more because they knew there wasn't something that was going to, something in the small print that was going to bite them later. And I mean, the fees are mysterious. It's a lot of banks, and they're big. I want to tell you a story from something that happened a few days ago to one of my wife's students at Berkeley. She's on maximum financial aid. She's maximum work study. She has a really prestigious scholarship for kids who are the first in their family to go to college. And there was a little mix-up in the work study office. Some paperwork didn't go through right, and her check, which always deposits, so it direct deposits on Friday, it was delayed for a couple of days. So on Saturday, she went out, she picked up a few things, she paid a couple bills, and then she realized the money hadn't been deposited. She caught it pretty quickly, a day later. But in that one day at Bank of America, she got 7 overdraft charges for $245 of fees. And that story is going to become legend. Everyone that she has ever met is going to hear that. And the dollar amount is going to grow. You know, if it's 6 months from now, it's probably going to be 14 fees. It's going to be $1,000. It's going to become larger than life. Just one little thing like that. And that's a really important thing to realize when we talk about check cashers and payday lenders and banks, is that you talk about some of the fees for some of the credits, but the overdraft charges can get used like loans, as you know, and you can't annualize that interest, so it's hard to compare. It becomes sort of apples and oranges. A little off topic, I'm not going to get into that, but it's a bit of a pet peeve. Now, I'm not apologizing for these businesses, like I said before, and I'm not saying that everybody loved going to them. A lot of people cited the high costs. But the customers I talked to, you know, maybe if they weren't perfectly rational in an economic way, and they weren't perfectly irrational either. They made a lot of sense. The industry got big, I finally decided, because it sold itself effectively as a reasonable option. And in the push to regulate bad options away, it's important not to throw out the knowledge that these places have built in the way that they were able to sell themselves that way. Critics told me that these places are marketing geniuses, but it's not really about ads, and it's not about something on a bus stop. It's not about promotions. It's that they know their community, and they're embedded, and they know what sales pitches are going to work. And they do a lot of things that actually a community institution like a community bank is in a unique position to do, which is one of the reasons that I find this proposal so interesting.
We're going to open this up to questions, but just before we do, I think Ellen has one that she got a two-hander on.
Yeah, and Jan, I don't mean to put you on the spot here, but I must say that in some of my other life, the issues that Doug has raised are sort of front and center of what I work on, which is how can we get community banks and credit unions to be more positively effective with the lower income consumers, and to make themselves attractive in contrast to the check cashers and the payday lenders, and there's a sort of backside piece of that, which is that Wainwright obviously does a huge amount of enormously important work in the community. You're publicly traded, and yet you've avoided apparently the constant push for ever increasing returns that Josh cited as part of the reason why we got in this mess to start with. So I'm really sorry to put that on you, but you know, you're not just here as you, I guess.
The last issue first. We are publicly traded, but we do benefit from a source of patient capital, and the two co-founders of the bank, who are the current co-chairmen, have a controlling interest in the bank, and started it for reasons not to just build it up and sell it, but for other reasons. So that's been certainly helpful. As far as sort of reaching down to the unbanked in the community and the challenges that presents, it is a challenge. We've tried to attack it through basic no-cost checking accounts and savings accounts for the folks, and really financial education, financial literacy education is one of the things that we've been very active in, and getting that into the school systems is a challenge. And we've been working in Massachusetts trying to get that as part of the curriculum at all levels, starting in elementary school, junior high, and high school. And you're competing. There's so many competing interests there that it's really difficult to get the folks to include it as part of their normal education, because the teachers don't have time. They complain that they don't have time to teach the existing subjects and then adding something else on there. But we go out, our folks volunteer and go out into the neighborhoods, into the schools, talk about savings programs, talk about basic financial literacy issues. And that's one of the areas that we're trying to attack.
Yes, sir.
I see a lot of appeal in this return to a very local thing. And there's a lot of trends that are moving that direction, even things like local production of food. So there's a lot going on there that supports the idea that underlies, I think, what most of you talked about. On the other hand, with the digital world, we have a lot of things that are community that aren't geographically based. And so if any or all of you could say what you see as the potential for community-based financial institutions where the community is not a geographic community, I think that would be very interesting.
Let me make a comment on the local food point first. One of the wonderful things that community banks and credit unions can do is support those producers of local food, whether it's the farms or the cheese factories or whoever is doing it, and they're much more likely to be willing to support that kind of small business than some of the bigger entities. So I think the whole trend that you're talking about sort of is of a piece. The issue of community that's not physically one, I do think is an important one, and we know of at least we know of a couple of actually very large institutions where the community is the military. And that are quite successful at serving that community, and over the years have been induced to serve that community lower and lower and lower and lower into the ranks, as opposed to just the senior officers. So I think it's possible. I do think the point that we've made about civic engagement in place is what you lose when you focus on the sort of virtual community. So my point would be that the virtual community idea is a real one, and it's a potentially viable one, particularly when your community is relatively big. But it's not the same as what we're talking about because this other piece is missing.
I'd actually like to add a little piece to that, which is, in 04 and 05, I started saying to people who thought I was crazy that we were going to see housing turned down not regionally but nationally. And so that's crazy, that doesn't happen. And the reason that I expected it to happen actually was because underwriting standards went from being, lending standards went from being regional to national. Okay. And as you saw the aggregation and the concentration and the automation of those standards, you ended up making sure that everything looked like everything else. And unfortunately, I think, again, it would be very hard to actually successfully, at this point, really hobble together a virtual community that actually could effectively manage its loan book without really actually running and identifying its lending standards in each of its lending categories, other than on a local or regional basis. So that having to do that would actually take away a lot of the synergy of building it in multiple regions, which is, I think, part of what got us to where we are. So I think that actually is another constraint, and I think that, if it's going to work, it really, to some degree, has to be a very clearly delineated and identified community, whether that is a geographic community or a demographic community. But it's got to be identified and targeted, and the loan book also has to similarly be matched. Yes, sir.
David Morrison with the Credit Union Times. Mr. McRae, what was the name of the credit union that you all visited?
The one that I visited in LA. I don't remember off the top of my head, unfortunately.
Okay. Ms. Edom, is there anything in the proposal about how to deal with some of the charter and structural impediments that the credit unions have?
Yeah, one of the things we do in the proposal is, the proposal is a skeleton and outline, but we explicitly recognize the fact that both mutual institutions and credit unions don't have broad ownership and don't have the equivalent of stock. And the concept we throw out there is net worth certificates, which of course were used during the savings and loan crisis, actually not all that unsuccessfully. But the point is there are kinds of financial instruments that you can use to provide equity support for credit unions. As you know, low-income credit unions are allowed to take secondary capital. The problem, of course, with secondary capital is because of the way it rolls off, it can actually be a sort of exploding device all by itself.
Right.
We need to figure out a better mechanism.
Well, the reason I asked is because you mentioned that this was explicitly targeted towards not just lower income CDFI sort of institutions, but I mean, like for example, credit unions are the only financial institutions, the only cooperatives where members cannot actually invest in their own institutions. I'm a member of a credit union. I cannot go to my credit union and say, I love this credit union. I would like to invest my money with you. You know, if you have the kind of equity that you're talking about, by law, I'm not allowed to do that.
Yeah. I mean, I think the issue, we were very, as we wrote this paper, what we wanted to do is to make sure that the credit unions were included as part of it. I think the whole question of exactly how you equalize the opportunities across these various corporate structures is something we've just got to deal with.
Okay, thank you.
I was just wondering if anyone could speak to, given the safety and soundness issues we've seen in the past few months, wouldn't it be perfect timing to close current loopholes that we've recognized, such as the ILC loophole?
I'm not going to get into that. I mean, I think the point we're making is that small local institutions need greater support. The question of what we do about the big guys and whether we, how we change the regulatory system with respect to them is not something that we've covered in this paper.
I mean, at this moment, it actually seems like the goal is to allow anything.
Right.
Okay, which works against that notion.
Right.
But there is, on the other side, this other natural tendency in the land grab for TARP assets for people to actually not be ILCs, but to go file bank charters. So
Okay.
the ILC is functionally being killed anyway by the fact that everyone wants to actually get your money
Right.
through the tax, through the TARP.
Jen Price with the Nonprofit Finance Fund. Just curious, as you discussed the support for small community banks, what type of real or perceived risk and pushback are you getting right now, in just a broad sense, to some of the proposals you're putting forth?
Well, since we carefully didn't put the proposal on the web until this event started, we haven't gotten any pushback yet. I can anticipate that one of the issues we will get is this whole question of the effective definition of what a community bank or credit union is, and making it narrow enough so that it's meaningful, but broad enough so that communities that do not necessarily meet the low-income standards can also be served, small towns and other kinds of communities. I expect that we will also get a fair amount of pushback on the question of how do you create an equity instrument that does what we want it to do, while simultaneously not completely destroying the leverage of the other shareholders. Dan, do you want to?
This is probably more geared towards you, Ms. Simon, but in regards to your proposal, that $30 billion that would go into the fund, there's $60 billion left of the TARP money that's in the capital purchase program. Would you see some of that or all of that money coming from that, or is that?
Yeah, I mean, our proposal was that that's where it would come from.
Thank you.
Yeah, I guess this is a question for Mr. Miller and maybe Mr. McRae by extension, because you seem to understand the consumer behavior and psychology side of things. I just graduated from school in Boston, and when we were freshmen, a friend and future roommate opened an account at Wainwright because he was attracted by your, progressive values and, interest in investing in the community. However, after a few years, he left the bank for one of the big behemoths, probably Bank of America, because of the sheer economies of scale that it offered. And I know that I, ran to one of those companies because there's a certain value in never being more than, a stone's throw from one of their branches. So my question is, how do you respond to a society that is ever more on the move, first of all, and ever more obsessed with efficiency and sort of on-demand access to financial services? I guess that's for both of you, perhaps.
And I'm sorry he left Wainwright. He shouldn't have done that. He couldn't talk to me. I told him not to. And we get, one of the things we talk about, the loyalty issue is, we do a closed account survey. We get a tremendous response from, and 70% of people close their accounts because they're moving out of the area. And I think every bank that does a survey finds the same thing. But it's amazing how many of those folks take the time to send me an email, write me a little note, or call me. Less call, frankly, most send emails. But that sort of describes maybe how we can compete with that. We have, in Massachusetts and spreading throughout the country, the opportunity to join ATM networks that provide free ATM access for customers. So that's one way. And online banking, even though we want the relationship, we feel that we can build the relationship through our value proposition, and therefore the online banking somebody can continue to bank with us really no matter where they are. But the challenge is to compete with Bank of America with an office at every corner.
And the only thing that I'd add on to that, it's a really good question. My piece was focusing really specifically on much lower income neighborhoods and people who've been at most had maybe one foot in the banking system. So having an ATM machine in every airport and every neighborhood isn't quite as big an issue as it isn't as big as an issue as some other things.
We had seen, if you remember, the big banks actually less than a decade ago all make the pronouncement that they intended to get as much out of the retail banking operations as they could, and it just was because consumer was the only actual area of potential growth that they got there. So I think one of the other pieces that we'll start to see is actually a shrinking of the branch network market. The efficiencies really aren't there, and at some point, the fee income that you need to charge to support those branches actually starts working against you when appreciation of assets stops, which is really where we are. So you do have to wonder if part of that could ease a little bit as we end up seeing sort of the closure of Starbucks and some of the big bank branches.
The interesting piece there too is that while everybody's predicted that, we have more branches today than we've ever had too. So I think you're right. I think at some point in time, the other issue that, and again, it goes back to the relationship banking. I'm sure you've had no problem on your account, and that's the issue. If there's a problem, it really is helpful that you can walk in and talk to somebody that you know, or that you can email the president of the bank and he'll respond to you on his BlackBerry, which is BlackBerry.
Yeah. This is for all of you. This has been so helpful. And it gets to the relationship banking, lending, and a comment that you made, Mr. Rossner, about sort of seeing the escalation of the problem. I mean, from the standpoint of lower income households and trying to democratize credit, I mean, systematic credit assessment has been really useful. For the small banks, what they do, it's this inability to actually capture it as a variable, that sort of handshake, the strength of the handshake. Clearly, we don't want to throw the baby out with the bathwater, and we need to get a little better about assessing credit risk. I'm just curious, I mean, even the check cashers, I mean, they know their customers. How do we start to actually better understand the customer, what you get through the relationship banking, but in a way that you build it into assessing the individual, you know, in terms of their credit risk overall? How do you make a variable out of what is a very, you know, non-tangible relationship?
Yeah, I mean, I think that actually is obviously the problem at hand broadly. But I think that you can't really feel comfortable watching safety and soundness regulators sign off on new underwriting methods without some basis of empirical data, cyclical empirical data, which is really what we've been missing here, right? Is we actually started lending to a borrower who never existed before, called the subprime borrower. Okay? And that borrower, frankly, I've placed the equity in probably 50% of the previous subprime industry that existed in the mid-90s. These were small little lenders called with names like Migo Mortgage and Conti Financial and Cityscape Financial. And at that point, subprime was defined by the borrower, really FICO score, as opposed to by the product that they took, because they were still generally traditional products. And the term subprime became perverted and non-standardized. And we felt comfortable that we actually had data on the performance of that borrower. So it's very hard to actually make that determination until after you've seen a full cycle of performance. You know, we'll get right back to that crisis of answering that question again, but I think that the comfort with models is actually going to go underground for a little bit. And so I think, like it or not, we are going back to some degree to traditional manual handshake-driven underwriting.
But that raises risk, potentially, in terms of people who may not get sold for various reasons.
But there's no question about
Yeah.
that. But you know, you
So
also.
maybe we see more people go into that.
Well, except for the fact that I'm sure that institutions that actually did hold loans on their books probably also learned a lot by the expansion of their underwriting. And so they probably do have quite a bit of information on borrowers that they wouldn't have in prior cycles lent to, but because of competitive issues did lend to. And they actually may be well informed as to which of those borrowers, those new borrowers, actually were worthwhile risks.
You know, it's worth thinking too, that where did these small scale institutions come from? Most of them date in origin back to the progressive era, with various immigrant groups that were excluded from, you know, the WASP-controlled banking system. And so, even to this day, you can see the remnants. There's a Madison Bohemian Bank north of Baltimore. That's from the Bohemians, of the Bohemian farmers of Hereford County in the 1840s. You know, couldn't get a loan. And so there's possibility here, although, you know, small-scale banking can be clannish and can be exclusionary. It's also a vehicle by which discriminated groups have in the past and can in the future begin to build their own financial institutions. Yes, sir.
For Mr. Rosemary, you talk about potentially busting up. I believe the top 4 banks in the country control between 40 and 60% of the assets. Is breaking up the large mega banks, is that something that's realistic and doable? And also, what do you think about the 10% deposit cap? Should that be lowered or at least not raised?
On the latter, I think that it probably should be left largely unchanged, the deposit cap. In terms of the breaking up, I'm not suggesting that we go in and break up institutions if they're safe and sound. What I'm suggesting is that there are institutions who really are not fundamentally safe and sound, who are being kept alive because of a notion that they are too big to do anything else with. And so I'm really talking about very select 2 or 3 institutions of the top 9
Okay.
or so.
I want to go back for just a second to the prior question and to Phil's response to it, because I really do think that we don't want to get too romantic here. And it's important to recognize that there were definitely groups there definitely were and definitely are groups excluded from the community banking world. I think one of the things, and that you know, discrimination in banking is still a serious issue, and it's a serious issue not just in sort of in fact, probably much less in terms of, overt discrimination than in terms of being open and welcoming, in the sense that Doug was talking about the check cashers being, and the credit union he visited not being, and frankly the credit union that he featured in his story trying to be. But I think one of the ideas here is to provide some strength to institutions that do want to behave the right way, and what we need to do is to get the metrics right to make sure that that's who's getting the support.
Could I actually just respond in one place? And this is actually, if I have eggs thrown at me, I'll have eggs thrown at me at this point. I mean, there is this other notion that we should necessarily accept losses for doing the right thing. And perhaps actually we have to also stop and say that some of this notion that everyone deserves isn't right. Okay? This notion that we should increase home ownership to 70% all-time record levels, right, by gerrymandering how we get there, doesn't actually serve any of the populations. You have to remember that a lot of those who were actually forced into, and I do use the word forced into because it was an artificial inducement, home ownership, are precisely those who are suffering the most now. Okay? And so perhaps actually there is an equal danger in including people who otherwise might not be included when you actually put them at greater risk and don't provide any education for what they're getting into or help for them prior to. And so I don't mean to sound, whatever, unpolitically correct, but I think that there is a real danger in doing what we've done. I mean, all of that increase from 64.5% to 70% really came on the backs of the population that could least manage that.
But to some extent, wasn't that because it was a shortcut? It was the subprime borrower, quote unquote, and he became like a vehicle, or he or she became a vehicle towards this. Well,
but they were gerrymandered into the systems that allowed the loans to be underwritten, and I would say that Washington is really, if we want to get to the core of it, to blame for the whole crisis, because, and I'm being very serious actually, because incomes in this country have remained relatively stagnant for the better part of 40 years. And so as opposed to getting home ownership up to 70% by increasing wages and getting wages up, we actually decided to take a shortcut method and just lower the hurdle so that you didn't have to have any down payment for the first time in 200 years, literally 200 years.
My point was that there is another approach to this subprime borrower, which is the approach from alternatives credit unions like it, which is basically where,
Absolutely.
Okay, you say, this person we're going to work with here, we're going to work with them probably 18 months before they
Absolutely.
actually get the loan.
And if we were doing it that way, or if we decided that as social policy, we would backstop those borrowers and be willing to take the loss or subsidize, that would be fine as well. But if those programs were in place, then the lenders would not have the same concerns in lending to those unbanked populations.
Right.
Yeah, I think that's a really important point, that at least through about 1999, which is when, frankly, the bulk of the increase in the home ownership rate happened, there was good lending going on to people who hadn't been able to get those loans before, and we can't lose that in the attempt to undo what we've got today. I would say that community banks and credit unions are the place where that kind of good lending has been going on, and that's why we need to encourage them to keep doing it and to be strong.
Okay, we have time for one more question. In the very back.
In terms of the question of figuring out the most effective ways to integrate and to reach out to low-income communities, the working poor, and bring them into the banking system, the financial system, I was just wondering whether there might be any parallels to be drawn or even lessons to be learned with how microfinance and microcredit has worked in the developing world and the successes and limitations of that.
This is always a tricky question, not the least because there's now a major movement in the developing world to recognize that microcredit is not the entirety of microfinance, and that in fact deposits, savings, and insurance are at least as important as the credit side. I think that there are some interesting opportunities that actually if you go back to the origins of these the immigrant institutions, if you go back to the origins of the mutual savings and loan, the sort of circle of relationship, the mutuality, all of that, which is at least the basis of the Grameen model of microlending, although not all models of microlending, is exactly what we're talking about here. It's all about relationships. And I think in that sense, it's really very consistent.
Well, thank you so much for coming.